My guest today is Alessandro Gavazza, who's Professor of Economics at the London School of Economics and Research Fellow of the Center for Economic Policy Research. He's an applied economist with main interest in industrial organization. His research focuses on the role of frictions in markets. Welcome, Alessandro.
Thank you. I'm delighted to be here with you today.
Yeah, thanks for doing this on a Sunday. I have a few of your working papers. I thought we can start with mortgage pricing and monetary policy. You say this paper provides novel evidence on lenders' mortgage pricing and how central bank policies affected it. Using the universe of mortgages originated in the UK, you say we show that lenders seek to segment the market by offering two-part tariffs composed of interest rates and origination fees, and that during recent periods of unconventional monetary policy, such as the UK's funding for lending scheme, lenders decreased interest rates and increased origination fees. So I'm not familiar with the funding for lending scheme. Could you talk a bit about that? What exactly is that?
Absolutely. You may remember a few years ago, during the European sovereign debt crisis, there was some turmoil in wholesale markets, and in particular, sovereign bond in Europe experienced a spike in the interest rate, in particular of peripheral countries. So central banks in Europe, the European Central Bank, most notably, but also the Bank of England, started new monetary policy operations that allowed lenders to access funding directly from the central bank. So traditionally, the central bank is the lender of last resort. And since the European sovereign debt crisis, instead, many banks in the euro area in particular have been heavily funded by for example, the European Central Bank. In the United Kingdom, the Bank of England started similar facilities, although they are less relevant now for banks relative to how important they are in the Eurozone area. So we study,
yeah. So this was part of the COVID shock?
No, I'm talking about several years ago. So the European sovereign debt crisis was around 2013. And so the facilities that we are talking about are around that time.
That time, okay. And so the idea here is that central banks provide liquidity, more liquidity for the lenders, with expectation that that money gets into consumers' hands more easily. So was that the idea?
Yes, the idea was that funding costs of banks were particularly elevated at the time because of the European sovereign debt crisis. So, of course, sovereign debt the prices of sovereign debt was affected, but also wholesale funding was heavily influenced as well. Therefore, to reduce the cost for lenders, the central bank started new facilities in which they were offering loans to banks.
And so interest rates and origination fees. Interest rates, some of the interest rates we can observe in the market, origination fees is sort of cloudy in the US. I think they call it points or something like that.
Yeah.
And every lender has, their own ways of doing this. So is it so they're using these two levers to really get to the consumer, right? Because different people may even understand these two factors differently, right? Is that one of the issues?
Yes, absolutely. So there are always complicated calculations when you are taking up a mortgage. And so these different price components matter for consumers, and it's not always straightforward to add them up. because some of these components are variable. So the interest rate essentially multiplies your loan size, whereas there are some fixed components such as the fees. And so adding variable parts and fixed parts is not straightforward sometimes, in particular for consumers who don't have great financial sophistication.
So isn't there some sort of a standardized way of looking at this? I think in the US, there is some way that they say, you know, they can put everything together into a singular number, and that is more easily digested. Is there anything like that in the UK?
Yes, absolutely. So the APR is a way of summarizing different fees and different interest rates. Although very often the interest rate is a lot more salient for consumers relative to the APR. Okay, so very often, let's say lenders advertise the APR, the interest rate, and the APR exactly because varies across consumers depending on the size of the mortgage. It's less easy to advertise to a broad population. But
And I would, sorry, Alessandro, I would imagine there's tax effects here too, right? So the consumer may have some optionality here in terms of pushing payments to certain periods of time where they may have a favorable tax treatment. That is also an issue here, right?
okay, in the United States, interest payment is tax deductible, whereas in the United Kingdom is not. So some taxation considerations may be less relevant for the UK market relative to the US market.
Okay. And so what's your conclusion here, or what are your observations here? So unconventional monetary policy, lenders were given almost easy money, and they take that and they use it in different ways, right? So segmentation of the market. Could you talk a bit about what all things you observed there?
Yes, absolutely. So we find that these funding for lending scheme, which are the central bank operations that the Bank of England started during the European sovereign debt crisis, were quite effective at reducing the funding cost of lenders. Lenders, because their funding costs were now lower because of the central bank facilities, reduced the interest rate that they charge on new mortgages. And so consumers benefited from the decrease in interest rates that they were paying. But at the same time, we do find that lenders charged higher mortgage fees. So the benefit to the consumer was partially offset by the fact that lenders were able to capture through fees some of the benefits of the decreasing costs that they experienced.
Is it a regulatory issue, meaning interest rates are easily observed, maybe origination fees can be hidden different ways? Yeah, was that the reason they sort of shifted?
I mean, as I said, certainly when in the United Kingdom lenders advertise mortgage rates, there is a lot of focus on the interest rate, whereas the fees, for example, in the ads, are a lot less salient. If you go on a website of a lender in the United Kingdom, the fees are usually quite clearly disclosed. Okay, but again, we know that in many of these consumer finance decisions, consumers might not fully understand all the features of a product. And so in particular, they might not fully appreciate that in addition to interest rates, they may have to pay origination fees, and these origination fees vary across mortgages, across lenders, and so they may be less salient than interest rates. And as a result, lenders may have incentives to advertise low interest rates, but at the same time try to gain a little bit more profits by charging slightly higher origination fees.
It's also a question of financial flexibility, right, from the consumer's perspective, because origination fees is sort of a lump sum fixed amount upfront payment that they're making. I would imagine only a cohort of people would be able to do that, right? So is that how they're differentiating the market? I mean, segmenting the market, I should say.
Certainly, higher income individuals, because they take larger loans, benefit from paying these origination fees upfront with the idea of getting a lower interest rate. And so that's the sense in which this pricing with origination fees and interest rates allows to segment the market between some consumers who have larger mortgage loans and some other consumers who might have smaller loans, who may prefer instead a lower origination fee but a slightly higher interest rate. And so that's the segmentation that we are really studying in our paper, because in the United Kingdom, pricing of mortgages is a little bit different from the way it is done in the United States, in that there is no personalized pricing. So there are essentially posted prices. So lenders set a menu of interest rates and fees, and consumers choose between these different options available to them across lenders and within a specific lender. And therefore, consumers who might have larger loans, so they want to buy a bigger house and they need, more money, they may prefer lower interest rates but pay an upfront fee, whereas consumers who are buying perhaps a smaller house require a smaller loan, and therefore they may prefer just a slightly higher interest rate but pay no fee.
Yeah, so if I understand this correctly, Alessandro, the insight in the paper, if I understand this correctly, is that it's from a policy perspective, instinctually one could say fees are bad, you should just get rid of fees instinctually. But what you're finding is that that is not a good policy, right? Having fees allows more flexibility, more segmentation, better product design, and all of that. So could you talk about, I think I remember reading both consumer surplus and lenders' profits increased from this process. So what is the mechanism there?
Yes. Well, the idea is very similar to traditional price discrimination. So when a seller price discriminates across among heterogeneous consumers, this just by the fact that they are price discriminating, it is quite plausible that price discrimination benefits sellers. Otherwise, they would not do it. But the traditional question in economics, and in particular in industrial organization, is whether price discrimination benefits buyers as well, benefits consumers as well. And here we do find that price discrimination benefits consumers as well. So if for whatever reason, let's say the regulator does not allow lenders to price discriminate across these heterogeneous consumers, uniform pricing would hurt some type of consumers, and the reduction in consumer surplus of these consumers is the main first order effects that reduces aggregate consumer surplus in the market. So the fact that there is a group of consumers that would reduce the quantity that they borrow reduces consumer surplus in this market.
So if there are two factors in the design of the product, interest rate and origination fees, I would imagine the lender would have sort of the same net present value computation when they design different products. So from a lender's perspective, then PV of the different products, I'm just speculating, are roughly the same. And if that were true, then how will the how does the consumer benefit from that?
Yeah, so because the consumers are different. So imagine just two individuals. Imagine you and me in the market, and we are facing just one lender. You are richer than me, and you're going to borrow more than me. Uh, I have a lower income than you. I'm going to borrow less than you. Uh, and so there is a benefit for the lender to price discriminate between you, who are going to have a large loan, and me, who are going to have a small loan. Okay. If the lender cannot price discriminate between me and you, okay, the lender is going to charge the same interest rate to me and you. And you are going to have a smaller loan. Okay, I'm going to have perhaps a slightly larger loan, but the decrease in your loan, okay, is larger than the increase in my loan. Therefore, the quantity of lending goes down, and as a result, also your surplus goes down by more than my surplus goes up. And as a result, when we aggregate all consumers, in this case, just me and you, the overall effect is that your decreasing surplus is the dominant effect in the market, and therefore aggregate consumer surplus goes down.
So if I understand this correctly, Alessandro, so what you're saying is that disparate consumers with varying constraints, if given the same product, will have less consumption, really. I mean, some of them cannot do it, some of them can easily do it. But if there are a plethora of different products with different features, then there are more choices in the market, and that might design into the needs of different customers with the varying constraints, right? Varying financial constraints, perhaps.
That's right. So that's absolutely right. Is all predicated on the heterogeneity of the consumer. And so you and me, in the example I was giving before, are different individuals with different desired loan amounts. Right? And so price discrimination allows targeting of prices, but also of products to these two different type of consumers. And as a result of this targeting, also the consumer benefits from this targeting, not exclusively the seller.
So, monetary policy perspective, will the authorities have a target? So, in this unconventional monetary policy, they want certain amount of liquidity to show up in the market. If the lenders go off and design products that are sort of different from what the Fed's expectations are, would that create a problem from a policy perspective?
I mean, I think your question is an insightful question. In the specific case that we are analyzing in our paper, I think the general idea of the central bank was to expand lending. Traditionally, these policies have the desired effect of expanding, in particular, corporate lending, so lending to firms. And in the case of funding for lending scheme, indeed, lending to households, so mortgage lending, more importantly, was initially allowed, but then it was excluded from some of these central bank facilities. The idea was that targeting housing markets presumably could have increased house prices as well. And there was a concern that increasing house prices was not a desirable target per se. Rather, it was better to use this money to increase corporate investment, and through corporate investment, employment, GDP, rather than using this money to boost the housing market.
And asset price inflation.
Exactly.
Yeah.
Exactly. So
So you have a related paper, again, a working paper, Alessandro, refinancing cross subsidies in the mortgage market. You say in household finance markets, inactive households can implicitly cross subsidize active households who promptly respond to financial incentives. We assess the magnitude and distribution of cross subsidies in the mortgage market. So, yeah, this is very intuitive. So, those households who are essentially looking for changes in the interest, go out and refinance, do all sorts of things, and the rest of the market sort of sit back. And the ones who do it are the ones who are going to benefit, but it's sort of implicitly paid by the ones who don't do anything, right?
that's exactly the idea of this paper. We have very detailed data, again, from the United Kingdom that are coming from the Bank of England, and we try to measure exactly this cross-subsidization that you were describing. The idea is that you are, imagine two consumers like before, okay, you are a lot more financially savvy than I am. You promptly refinance, whereas I'm a slow refinancer. In equilibrium, you are going to get a lower interest rate than I get. And so implicitly, the fact that there are these sluggish refinancers in the market allows lender to offer discounts to the prompt refinancers. And therefore, you are implicitly cross-subsidized by me, who's slow at refinancing.
Is there any policy implication here, Alessandro? I mean, can you actually, given that this is happening, can you negate that somehow?
Well, it's hard to do it in the sense that aggregate interest rates change. In the United Kingdom, also, again, different from the United States, there are no 30-year fixed interest rates. So the fixation period on a mortgage is usually a lot shorter. On average, is between 2 and 5 years. What this means is that you have a mortgage, let's say, for 30 years, but the interest rate is fixed for, let's say, 2 years. At the expiration of these 2 years, you either have to refinance to get a low interest rate. But if you are inactive, and so you do not promptly refinance, your interest rate automatically jumps up at a much higher interest rate. And as a result, there are these cross subsidies that we were describing previously. The way policy can affect market design is a very interesting type of question. And obviously, in the United States, there are a lot of policies that are affecting, for example, the secondary market for mortgages. And as a result of the effect on the secondary market for mortgages, the effect on the primary markets are also affected, obviously. And by which I mean, all the government-sponsored enterprises that are operating in the secondary market for mortgages. In the UK, there are no such policies, and therefore most of the mortgages stay on the books of the lenders, of the banks. Therefore, the way these lenders deal with interest rate risk is very different from the way the US mortgage market deals with interest rate risk. And as a result, the fixation period on the mortgages is a bit different.
Yeah, it's interesting. So I didn't know this, Alessandro. So 2 to 5 year mortgages clearly means that you have to sort of roll that forward because most people won't be able to pay off the entire mortgage at the end of 2 years or 5 years. So this is a bit like adjustable rate mortgages in the US, right?
There are some similarities, but it's not exactly identical. But I agree with you that here in the United Kingdom, everybody talks about fixed rate mortgages, okay, because there are variable rate mortgages that adjust, let's say, every month or every 6 months, depending on the benchmark rate. But here, when people talk about fixed rate mortgages, they really mean a 2-year fixed rate mortgage or a 5-year fixed rate mortgage, which for a US audience is obviously a short-term period in which interest rates are fixed.
Yeah, it's a bit like, I don't know if such products exist, but they could be some sort of a step function adjustable mortgage rate that, the mortgage rate doesn't change within 2 years or something like that. I suspect there are products like that in the US too, potentially.
Yes, they have a small market share because the 30-year fixed rate mortgage dominates the US mortgage market. But obviously, some of these products existed. They were actually reasonably popular before the great financial crisis of 2008. But they have lost a little bit of appeal since then.
Yeah, I mean, it's a complex product for the consumer. And so there are clearly inefficiencies here, right, in terms of information, understanding. When they actually buy a product, do they really understand all the implications? It's a real question, right?
Absolutely. And also they have a big effect in the aggregate. These days, when interest rates are increasing, and they are increasing at a fast pace by historic standards, a lot of mortgages are immediately readjusted to these higher interest rates here in the UK. Therefore, affordability is becoming a first-order issue for many borrowers. Whereas, obviously, the 30-year fixed rate mortgage in the United States may have some inconvenient side effects that perhaps in the current interest rate environment, it limits mobility. But if you are staying in your existing house, the affordability is unchanged exactly because interest rates are fixed.
So the Bank of England, if I'm speculating here, right, Alessandro? So in the US, let's say there's a higher percentage of fixed rate mortgages, 30-year long-term mortgages. They don't exist in the UK, which means that the Bank of England has higher control over the economy. In other words, if they change the interest rate, it's going to affect the economy very, very quickly, right? Everybody's
Absolutely.
interest rate is going to jump very quickly.
Absolutely. So some papers, some academic papers document that the extent to which the mortgages in a specific country are variable rate or fixed rate affects the transmission of monetary policy to consumption, to household consumption, exactly through the household budget. And so if your interest rate goes up, your expenditure on your mortgage immediately increases. As a result, your consumption has to adjust to still satisfy the budget constraint.
So is it easier to engineer a soft landing in such a situation?
Well, you're asking a tough question. So I leave it to people who are more experienced in these type of questions than me. I've always worked on the microeconomics of mortgages and so on. But as you say, certainly I became interested in these type of topics exactly because of their aggregate importance. And I hope that my research exploring exactly the microeconomic adjustment of households and lenders can help to understand these more macro questions, such as the one that you are asking.
Yeah, you have another interesting paper here. Dynamics of expenditures on durable goods, the role of new product quality. You say that we study the role of new product quality for the dynamics of durable goods expenditures around the Great Recession. a rich data set on US new car markets during 2004-2012, combining data on transaction prices with detailed information about vehicles' technical characteristics. During the recession, a reallocation of expenditures away from high-quality new models accounts for a significant decline in the dispersion of expenditures. So that is very intuitive. People don't go out and buy new cars in a recession. They're worried about their jobs. They're worried about other things. And so you tend to see sort of the used car market really perk out at that point, right?
Absolutely. So we put together some rich data to try to understand exactly the adjustment that households make when they are purchasing their car during a period of a recessionary period, such as the 2008 recession. This is actually a follow-up paper on a previous paper that my co-author and I have on a similar topic. And so the paper that you were mentioning exactly tries to understand first how households expenditure adjust, and second, whether there is any supply side response. And in that paper, we document actually that car manufacturers delay the introduction of some expensive models in the United States, exactly because aggregate demand for cars is lower, in particular, is lower the demand for expensive vehicles. Therefore, there is no incentive for car manufacturers to launch new expensive models because the consumers are not going to buy them. And so we do, we show that manufacturers delay the introduction of new expensive models.
Yeah, I was looking at you sort of look at the different empirical patterns, and you have charts here, dynamics of new vehicle expenditures, number of transactions go down dramatically. Average transaction price also goes down because demand is down. Maybe the manufacturers have to provide higher incentives to move the inventory. Also, the standard deviation of prices go down. So what is the insight there?
The insight is exactly that demand goes down more for expensive vehicles relative to, let's say, average vehicles, okay? And therefore, let's say the higher percentiles of the distribution of expenditures decline more relative to, say, the medium or the lower percentiles of the expenditure distribution. As a result, the dispersion drops during the recession, exactly because people don't buy the most expensive cars in particular.
And how does quality fit into these decisions?
Exactly. So if you think that more expensive vehicles have higher quality, which in the car market presumably is a reasonable thing to assume, then we do show that manufacturers are less likely to introduce higher quality vehicles, so the most expensive ones. But also we do a decomposition of technology, and we do see that technological progress during those years progresses at a slower pace. By which we mean, your car presumably now is getting increasingly sophisticated. It has a nice computer in it that does lots of different things. Driving it is a lot easier than it used to be, let's say, 20 years ago, and so on. All these are measures of technological progress applied to your car. And we just see that this technological progress doesn't move as fast during the 2008 recession. So the new models that are introduced, exactly for the reasons that I was mentioning before, there is lower demand for those, and therefore there are lower incentives for manufacturers to upgrade these models with the new technological features.
Yeah, so from a manufacturer's perspective, then, so it's not just pricing, it's really sort of product redesign they have to engage in in the middle of a recession, right?
Absolutely. They are launching fewer new models, and the models that they are launching are not on the same trajectory of technological improvements relative to the trajectory, to the trend they had before the recession. Before the recession, obviously, there was a big boom in the United States, but from 2007, 2008, we do see that there are fewer expensive vehicles launched, but also that the new vehicles that are introduced do not have many new features, obviously compared to the trend at which these new features were introduced before the recession.
Are these patterns sort of reasonably stable? What I mean is, are they predictable? So I'm thinking, in terms of manufacturers' design problem. Can they optimize the product they need to bring out in a recession by using these patterns?
Well, I mean, nobody likes to be in a recession, obviously, but it's a way also for the manufacturer to reduce some of their cost. Okay, so in a period in which you have lower demand, if you bring and you redesign many new vehicles, it's going to be expensive. And presumably also what the paper shows is that it's not the right time for manufacturers to do these type of expenses. And so they can just delay some of these introduction and some of these new product redesign.
The used car market dynamic would be quite interesting, right? Especially if you have more frequent recessions, the new cars are going to compete with potentially more advanced used cars. And then the consumer has to decide which way to go.
Yeah, I mean, I've studied throughout my career, I've studied the used car market quite extensively because I think it's a very interesting market. There are lots of different issues, issues of liquidity of the secondary market, the role of dealers in providing liquidity to the market, as well as giving certifying some vehicles and therefore reducing some information asymmetries or reducing transaction costs relative to a transaction between two consumers. So there are lots of interesting issues. And as you are alluding, there is the very interesting question of the substitution between the new car and the used car. And so as used cars become more and more durable, they are becoming better and better substitutes for new cars. And the only way in which manufacturers presumably can reduce the substitutability coming from the secondary market is by constantly upgrading new cars. And so they can make used cars obsolete by making new cars better and better.
Right. So durability also fits into the quality question, right? So, but when you buy a new car, you don't have a good assessment of the durability question. So how does it all sort of fit into the decision process?
I mean, many consumers who buy a new car keep it for a reasonably short period relative to the useful lifetime of a car. So in the US, more or less cars, let's approximate it just to make it simpler. Let's assume that cars last about 15 years, okay? But if you look at, there are lots of cars that trade right after 3 years. So a lot of those are cars that come off lease, so that when the initial lease expires, and so the consumer just replace them. But many consumers who buy regularly new car buy them every 3-4 years. Okay, so that's the first ownership spell of a car. And then there is traditionally a lower income consumer that buys this 3-year-old car and keeps it for about 5 years. So it goes from a 3-year-old car to a 8-year-old car. And then there's the market for quite old cars, so from 8 to 10, and usually those are then scrapped at 15 when they become 15-year-old. So a car basically has 3-4 owners, if not more. And so in the previous paper, we looked exactly at these, what we call quality ladder. The car is high quality when it's new, then it depreciates. And so there is a lower income consumer who drives this car, and then there is an even lower income consumer who drives it until it scraps it.
So if a large percentage of the buyers of new cars get rid of them in 3 to 4 years as the warranty runs out, what incentive does a manufacturer have to create durable cars? Because they don't really benefit from the secondary market transactions, right?
Well, presumably the consumer is willing to pay more for a car that is more durable because of the resale value. So for example, I'm sure you know, if you compare Asian cars versus US, so American cars, Asian cars retain their value a lot more than American cars. And so many consumers who buy new Asian cars also take into account that when they are going to sell it in 3-4 years, these cars are going to retain their value more than American cars. And so
sort of the residual value, the residual value goes into that decision. So a manufacturer that makes highly durable, high quality cars would want them to lease them and buy them back, right? Would that be more dominant choice?
You're asking a question that in economics has been studied extensively. What is the optimal selling strategy of a durable good producer? And it turns out that you're absolutely right, that in many cases, it would be optimal for a manufacturer to lease these cars, exactly because it has a little bit more control over the secondary market for these cars. Whereas if you are selling the car, you are essentially selling both, the use of a car for a few years, as well as the resale value that emerges at the expiration of this usage period. Okay. Whereas if you lease them, you may have a little bit more control over the use and the resale value at the expiration of the usage period.
Yeah, so a manufacturer who doesn't lease but sells shows a little bit of information to the consumer about quality and durability potentially, because most of the lease cars that I see, at least, they are premium cars. The Mercedes, the BMWs, the premium Asian cars, and I don't see a lot of mid-level cars being leased. So that sort of fits into the story, right?
You're absolutely right that higher quality cars tend to be leased more frequently than lower quality cars. But a trend that has been growing in recent years is the fact that now there are used cars that are also available for lease, which is something that is a little bit of a new phenomenon. But you're absolutely right that higher end cars tend to be leased more frequently. And it turns out that when they are coming off lease, also these cars sell at a premium. So consumers seem to appreciate the fact that they are coming off lease rather than buying a broadly equivalent car that has been just that the seller is selling rather than coming off lease.
Yeah, I just want to get your perspective, unrelated to your research, Alessandro. So, we have autonomous cars coming up. I remember reading a couple of years ago that car manufacturers are moving toward subscription model. So they don't want to sell you the car. They don't want to lease you a car. They want to just give you some time slots when you need to use the product. Do you think the market will go toward that?
I'm not sure how large it will be, the demand for these type of products. I live in a big city, and I am pretty sure that for urban consumers, this subscription model is a reasonable model. If you live in a more rural area, ownership seems to be just having greater advantages. But I live in a city, I don't need the car very frequently. So these, let's say, sharing type of arrangements might work reasonably well. What you are describing is a combination between the sharing and, is a more permanent type of sharing that is prevalent, I think, for consumers whose needs might change, and they want frequently also, a new car and so on. So it might there may be a niche market for which the subscription model works reasonably well. More generally,
sorry, go ahead.
Yeah, I would say that if you look at profits of car manufacturers or revenues of car manufacturers, an increasing amount of revenue is coming not from the direct sale of the car, but rather from servicing the car. And so the subscription model seemed to fit into that revenue proposition for car manufacturers, in which they want to have a larger flow of money from the consumer.
And they could start making cars that will never die because they now have an incentive to make the highest durable, highest quality product because they own it forever.
Yeah, that's an interesting market to see how it's going to evolve, as you say, with the electric vehicles, autonomous cars. So if you think about it, after your house, for most consumers, the car is the second largest asset that they own in terms of value. So it's certainly an important market, and so it's going to be quite interesting to see how it will evolve in future years.
Excellent. Yeah, this has been great, Alessandro. Thanks so much for spending time with me.
No, thank you so much for your questions. It's been a pleasure.
Thank you.